Hello and welcome to Covered Calls and Cash Secured Puts, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out there in the chat by my good friend, Barb Armstrong. She's going to be helping to facilitate the conversation, keep things going. So ask your questions if you're here with us in the live version. If you're in the recorded version, leave us a comment. We'll get back to you on that comment as well. So here we are at the start of a new earnings season. It seems like we just ended the last earnings season. Now we're coming into the next earnings season, and around and around and around the market goes. That brings up the question of what do I do as a long stock trader ahead of an earnings announcement relative to covered calls? Do I wait? Do I sell ahead of the earnings announcement so that the trade is done prior to? Or do I look at just managing to live through that earnings announcement and adjust the way that I sell the covered call? So we're going to explore some of those ideas. We're also going to explore the idea of some of the factors that we might weigh in the decision of where to put a particular strike price in selling a covered call. And part of that has to do with when is the earnings announcement and how far out in time is that announcement. So a couple of quick housekeeping items as we get started, and then we'll jump into those particular topics as well as a few others. As we get into this discussion, remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or solicitation of a particular security or strategy or anything else. Remember that any symbols that we look at are simply that, for illustrative and educational purposes only. We're going to talk about technical analysis. That's not the only way that you can look at the market. That is simply one way. They are all theoretical in nature. None of those are guarantees about what the market is going to do. Investing involves risk, including a loss of principal. One of the risks of selling a covered call is that the shares of the stock get called away from you. We'll talk through that idea here as well. Remember also, since we're talking about selling options, now we become the option seller. We've created an obligation. In an American style option, which most equities are, most individual stocks are American style options, anytime you have created a short option, there's the potential that that obligation could be assigned to you prior to expiration. So short options could be assigned at any time up to expiration, regardless of whether they're in the money, at the money, out of the money. It doesn't matter. Now, not something to be afraid of, something to understand and be aware of. And we'll talk a little bit about it as we get deeper into this discussion. We're going to be using the Thinkorswim desktop software platform. It is especially the paper money version of it. Not a guarantee of future success out there in the real world. Great learning environment. However, some things are different as you move into live trading. Number one, the paper money account won't facilitate early assignment of short options. Two, the fill prices that you will get in the paper money account are going to be different than the fill prices that you're going to get in a live trading account. In paper money, it's almost always going to fill at the midpoint. In live trading, that may not always be the case. So just be aware of that. We'll talk about the concerns and some of the circumstances of putting a stop order in a trade. Remember, the stop order isn't a guarantee of an execution at or near the activation price. And when we talk about covered calls, it's important to pay attention to the fact that if you are selling covered calls on dividend-paying stocks, we know that also that dividends can and do get changed or stopped. But one of the risks of selling a covered call is that those shares of stock could be called away, and now you no longer have those dividend payments. And so if that is part of your structure and how you've built, say, for instance, a retirement or an income plan, then selling a covered call carries with it that potential risk of interrupting or changing that income stream. So just be aware of those things. All right, we're going to pop over here to the Thinkorswim desktop software platform, kind of see what's going on. And once again, I've got Barb out there in the chat. Ask her some questions if you want. She'd love to answer those questions. So one of the things we talk about quite a bit in terms of covered calls is there an opportune time to sell covered calls? And there probably is in terms of the structure of a covered call trade, an opportune time. Whether there is one best time, I don't know. Whether there is absolutely an opportune time, that's a decision based on a lot of different factors. So we're going to take a look at what's going on in the market as a whole right now. Then we're going to look at some specific examples, and we're going to talk through kind of a 3 or 4 step process, if you will, of how we might make a decision about when, first of all, and where, second of all, to sell a covered call. Now, for those of you who are brand new to this concept of covered calls, welcome to you. We're glad to have you with us. The idea of selling a covered call is owning shares of stock and selling a call option against those shares of stock to bring in premium. It's called covered because you have the shares of stock to deliver against the obligation that you've created when you sell the option. Because selling an option creates an obligation. Obligations don't leave you with choices. Obligations leave you with responsibilities to sell the stock in the event that you're assigned that obligation. So we'll talk through and get into that discussion in just a minute. But I wanted to take a look at what's going on with the market as a whole at the moment. And this is not S&P versus technology, so I'm just going to remove that drawing right there. This is the S&P 500 index. Up a little bit on the day. We saw a little bit of a gap up, and it's rallying back up to about where its high was on Thursday, the last trading day of the week last week. The first trading day of the new quarter, the first trading day of July, first trading day of the second half of the year, and that's where we are. So a little bit of a follow through here today, moving to the upside, taking a look at the NASDAQ, a little bit less follow through, gap down and rally, but still kind of holding the apex of this symmetrical triangle, if you will. So tech was lagging, now starting to stick back kind of in that upward direction in this particular case, which is influencing a lot of investors. But at the same time, that idea that maybe tech is lagging a little bit brings about the idea that if a trader or an investor owns shares of a stock that's lagging in terms of price appreciation, well, maybe they're losing out on some potential opportunity. And the potential opportunity would be to maybe offset that lack of price appreciation in the underlying stock by selling a covered call. And that's what brings many traders to the doorstep of selling covered calls. Taking a look at the Russell 2000, the small caps kind of were up at the top of edge of this rising wedge, if you will, a little bit of a gap down and rally today. Upward movement, but not breaking out above new resistance levels. So the three broad market indexes, the NASDAQ, the Russell, the S&P 500, all kind of rising, but not really blowing the doors off of things. Kind of the way that we set ourselves up for a covered call trade. Now, the last thing I want to do from an overall setup perspective is I want to take a look at what's going on in the VIX, the volatility index. The volatility index is a measure, if you will, or an assessment of, just in general terms, how expensive options are. In specific terms, it is a measure of the level of implied volatility, or the relative expensiveness or cheapness, if you will, to kind of break it down, of S&P 500 index options. When those are expensive, it's presumed that there's a lot of buying pressure going on, that that creates that whatever is driving the market creates the reason for investors buying puts or buying calls. All right. As we take a look at this scenario at the moment, implied volatility being relatively low, sitting at now in the 15 handle, and right back down on these lows that we've really only tested once in the last kind of 3 or 4 months, April, May, June, July. We've not been much lower than this 15 range, 15.8 range. So that's kind of where we're sitting. Now this presents kind of a double conundrum for covered call traders, because it means that premiums aren't really juicy across the board. Even necessarily with if you see, to Josh's point, high beta stocks that are relatively volatile, or stocks that are going into earnings announcements. It means perhaps that implied volatility just isn't getting really juiced up. We're in the summer doldrums, right? We're in July, coming back from the July 4th break, if you will. So there's not a lot of activity, not a lot of juicing up of this market, but there's still premium to be had. So we'll talk a little bit about this in terms of the volatility of an individual stock. And so what I've got is, I'm going to pop over here to my monitor tab. I've got a list of stocks in this group. And this is my particular stocks group. And you notice that these are all, for the most part, 100 or 200 shares, sometimes 500 share blocks of individual stocks. Not all of them trade options necessarily, but I use this as kind of my dumping ground as I'm teaching and practicing here in this Thinkorswim paper money platform demonstration account. What I've done is I've sorted this list kind of as a filter, if you will. I've sorted this list by P&L open. And the reason I've done that is there's various times when I've bought these stocks, so I don't know necessarily without going to a little more information about the trade. So I could do that by going to the trade or the quantity column, and I can see, all right, when did I buy shares of Ross Stores, for instance? And I can pop that in, and I see that I bought that back in May in this particular case. But what I'm looking at is this P&L open. And the reason I'm looking at this P&L open is this is generally telling me, not absolutely certainly, but generally telling me those stocks that I've had some gain on in terms of price appreciation, which is going to kind of put me in the neighborhood, if you will, of uptrending stocks, which is kind of the prerequisite, if you will, for me of, and for many traders, of selling a covered call, because inherent in the idea of selling a covered call is owning the underlying stock. And it's anathema to that, to the idea of owning an uptrending stock, to have something in there that's going in a downward trend and then trying to sell covered calls against it. So the second question that I kind of have to ask after, is the stock going in the direction that I want it to go? Is it a stock that I have in my portfolio for a good reason? Is, do I really, truly, honestly, am I really, truly, honestly willing to sell the stock? And maybe even more specifically and pointedly, am I really, truly, honestly willing to sell the stock at the strike price that I'm likely to choose in selling the covered call? So I'm going to look at an example here. We're going to kind of drill down to an example, and I'm going to bring it into the context of the earnings announcement, because you notice right here in this monitor tab group, these are all stocks that I own. So we're going to primarily focus on legging in. I already own the underlying stock, not buy right strategies here. But taking a look at something like Citigroup. So yeah, I've got positive P&L since I bought it, right? Number one. I've got an earnings announcement coming up, number two. And number three, I've got this quantity here that's at least 100 shares. So I've got a bit of a profit in this stock. It's relative to the S&P 500, not hugely volatile, but neither is it, lagging behind the S&P 500. So here's Citigroup. And so we're going to take a look at that on the chart. I'm going to go to the chart here. I'm going to change my grid to my single grid. And this is just the toolbox sandbox that I like to play in. So here on Citigroup, I've got a couple of things, right? Yeah, and Sam says, could you do an implied volatility scan? 100%. Yeah, you certainly could. And we'll talk a little bit about that here. But here's Citigroup. It's in an uptrend. It's making higher highs and higher lows. It's coming up off of a little bit of a bounce here. And RSI is moving higher. Implied volatility kind of middle of the road, which we're going to come back to. But at this particular point, I know that I've got, by looking over the horizon here, I've got an earnings announcement on 7/14. So today's 7/6. That's about a week away. That doesn't give me a long time to be able to sell this covered call. Now, Mark says, yeah, but their implied volatility is somewhat meh. And I agree, it is. But here's the thing to think about. Either we take it from the perspective of, I'm going to sell the covered calls on the stocks that I own, or we take it from the perspective that I'm going to sell covered calls on highly inflated implied volatility stocks that maybe I don't own already, but I'm going to buy the stock and then sell the cover call at the same time. Kind of that buy right type of strategy. And Barb talks a lot about this, that buy right strategy when she teaches this particular webcast and this particular topic. So we're gonna, and Mark, I very much appreciate that. We're gonna approach this from the perspective of just saying, I'm gonna take it come what may. I've got a list of stocks. I'm gonna look at selling covered calls. Now, it may not be the most opportune time, but let's see how we can optimize this particular circumstance of selling a covered call and see if that makes sense. So, stocks moving in an uptrend. I've got a little bit of a resistance level here, up around the 148 mark or so. But generally, if I were to put on here something like, a 50 period moving average, and I'll just bring that visible here. 50 period moving average is tracking higher. So, not that that's guaranteed, not that it couldn't turn around, because it certainly can. But generally, I'm just going to follow the stock and move, with that upward trend. So now what I've got to do is determine, now I know where the earnings announcement is. So I've got a question to ask then myself around this earnings announcement right here. I've got 7 days. So do I do a trade that is 7 days long, or do I go beyond 7 days and sell further out in time? Because here's the thing. 7 days from now, right? 7 days from now, that's going to expire. That whatever option I might be looking at that's within that time frame is going to expire. So if I'm going to look at something that expires prior to the earnings announcement, then I have the potential to capture that higher implied volatility, rising implied volatility, but I take myself out of that trade ahead of some potential volatility and having the price of the stock move up through my short strike at close to expiration, and then having that stock called away. So if we have, let's establish one premise here. We're willing to, but our goal is not to have the stock get called away in this discussion. So that's what we're going to start with. Number one, our goal is we don't want to have the stock called away. I want to keep the stock. I'm okay if it gets called away, but I don't want that to happen necessarily, because this has been moving up, right? It's been motoring right along. So that's the first premise in this discussion. So now we need to make an assumption. Am I willing to hold through that earnings announcement and maybe sell a little bit further out of the money, bringing in a little bit less premium for the sake of selling a little bit more time? Or am I willing to sell a very short-term covered call, bring in a little bit of premium, and then do it again? So it depends on your activity level. So we'll explore both terms, both perspectives here. So I'm going to come back over here. We're going to go to the trade tab, and we're going to take a look. I've got a 17 July expiration. I've got a 10 July expiration. So let's start with the short end of the stick here. Now, before we get to that, so what we know that we're going to do is we're going to look at this expiration right here, 4 days to go until expiration. For some traders, they're going, that's nuts. Why would I do that? Some traders are going to say, hey, you know what, I'm okay with that, and then doing it again. I'm a little more active. But the next thing that I'm going to do is I'm going to come down here to the bottom of the option chain, and I'm going to say, hey, let's look at today's option statistics. I'm going to look for one number here as kind of a measure, and it's going to be this one right here, current implied volatility percentile. Okay, and all that's doing is it's putting the level of implied volatility, which is 36% on average, into historical context in the course of the last 52 weeks. So relative to the high implied volatility for the last 52 weeks and the low implied volatility for the last 52 weeks, current implied volatility of 36% puts me in about the 40th percentile. So the 40th percentile, we're going to assume, so I'm going to break this down, and we'll just kind of talk through this in terms of strike price selection and how it influences our delta and where we choose to sell that premium. So if I've got a percentile, if I've got a current implied volatility percentile that's between the 100th percentile Um, and say, for instance, the 50th percentile. So if we assume that 50 is kind of that midpoint, and we assume that this is mean reverting, the expectation is if I've got an implied volatility level that falls within this bracket, then premiums are juiced up, right? So what I can do is I can go to a lower delta, okay, lower delta, and sell a strike that is maybe outside the expected move of the price of the stock. But when that current implied volatility percentile is below 30 down to 0, so if this was the 30th percentile and this was the 0th percentile, if you will, right? If it's in that range, then what I'm going to be looking for and I'm going to feel comfortable with is looking for a higher delta because that implied volatility is relatively low. Now, okay, there's a primrose path here because a low implied volatility could beget a higher implied volatility. A lower implied volatility percentile could beget a higher implied volatility percentile. And a higher implied volatility percentile hopefully would beget a lower implied volatility percentile. But as we kind of have to make a definition here about what we're going to do. So we're going to look at putting our strike in order to get the same kind of delta a little bit closer to the price of the underlying stock. Now, there's this range right here from 50 to 30. What do we do with that? Because this is falling kind of right in that range between 30 and 50. So what do we do? Well, is it 6 to 5 and pick 'em? We just kind of flip a coin here and choose a further out delta, or do we choose a closer in delta? That's where we maybe have to go to the expected move and see where we're likely to be. So what we're going to do now that we've kind of determined what the current implied volatility percentile is giving us in this range, we know that we're kind of in this no man's land in the middle here because the choice would be easy. So let me kind of quantify this. If the implied volatility percentile is between 50 and 100, we might start targeting, say, for instance, the 0.30, maybe out to the 0.15 delta. Okay, so a 30 to 15 cent delta. If, on the other hand, we're in that 30 to 0 range, this is where we might start by going to, say, for instance, a 40 to 50 cent, maybe even that far, 40 to 50 cent delta. Selling a delta that's a little bit closer because we're expecting not as big a move, right? So now what we might do then is go to the expected move. And again, it's going to be based on that implied volatility. And so we're going to look at that expected move that is expressed based on that level of implied volatility. Speaking of expected move, I expect that you're going to move on the fact that there is a survey, a feedback survey out there in the chat. Barb's going to repost that. Do us a favor, help us make these sessions better. And the way you do that is by filling out that feedback survey. So we're going to take a look at expected move as part of this discussion as well. So we're going to look at either selling inside or outside of that expected move, depending on where we are here. So here's the thing. If we've got a high implied volatility, then what we might do is we might think about selling right at that expected move. If, on the other hand, we were looking at selling low implied volatility, and that delta is between 40 and 50, we might choose a strike price that is maybe outside of this expected move, or maybe even, again, right at that expected move, depending on where we are. So we can use that expected move as kind of a function of that expression. So we're checking when the earnings announcement is, we're checking what current implied volatility is, we're looking at the expected move, and now we're going to kind of filter this by using delta. So I'm going to clean this up a little bit, and we're going to go to the trade tab, and we're going to go to, once again, our expiration dates. So let's look at this 4 days to go until expiration, 10 July. $4 move. All right, so the stock's currently trading for $4.10. I'm going to round it down to $4 because we know that those numbers are oftentimes a little bit more exuberant. So I'm going to round that down. That means that the stock's currently trading at 143 plus 4 is going to be about 147. So if I'm thinking about this, and implied volatility is kind of in that middle of the road, I want to be selling at or just slightly above 147 if my goal is to keep the underlying stock. That's my kind of raison d'etre here, is to sell the underlying, or to keep the underlying stock. Say, all right, where is that 147 strike? Here's my 4 days to go until expiration. 30% or 39% implied volatility percentile. 147 is going to be right about the 22-cent delta. That's going to fall just about where I expected it to fall, meaning the probability of this option being out of the money and the probability of this option being in the money is a function of, and we can use delta as a proxy of, that probability number. So this 147 strike has about a 22% probability of being in the money at expiration. So that's about a 2-to-1, 3-to-1 type of scenario here. Just about a little over 3-to-1. All right. So we're going to look at that 147 strike. But the thing is, we're not bringing in very much premium here. All right. We're not bringing in very much premium. Now, that might be okay because we're talking about 4 days here. Talking about 4 days to go until expiration. So we're going to be out of this trade prior to the earnings announcement occurring, because this is going to expire on Friday. Now, to Mark's point, Mark brings up a good point, because if we go back to some of the other earnings announcements, we go back to where implied volatility was just recently. Implied volatility has gone down. So maybe we're in that phase where implied volatility is going down prior to the earnings announcement. So I'm going to look at selling this one. Now, could we sell a little bit closer? Yeah, absolutely. Could you sell a little bit further out? Yes, absolutely. But what we're trying to do is kind of narrow down this range of where might we choose if we're going to trade this, if we're going to sell this covered call on a shorter term basis that puts us in maybe that kind of sweet spot for bringing in a little bit of premium, but not getting called away. Now, there's not a guarantee that we're not going to get called away here. Could happen. Not likely to. Because we're kind of outside that expected move. We're right on that outside edge of the expected move. And we're at a fairly low delta in this particular case. All that's playing into itself. We've got a pretty healthy theta still. And not a lot of sensitivity to changes in implied volatility. Right? So, Sam, yes, I get that. I understand that, yeah, a lot of legwork to get here. It's explaining the process, right? We're bringing in 55 cents of premium, right? So you could do that. My point is, this challenge faces a lot of traders that have long stock positions. And a lot of traders have long stock positions. And I don't know all of them, but a lot of traders with long stock positions worry. So again, this says infinite max loss, but remember we got the underlying stock. So again, this says infinite max loss, but remember we got the underlying stock, so we don't have infinite max loss. Gives us a little bit of room. In fact, gives us $4 of room for that upside move. Oh, did we lose the live stream for some people? Okay. Yeah, all right. Cool. All right, looks like it might be individual server bases. Yep. Yep. No problem, Sam. And I appreciate you asking the question, Sam. It was a great question to ask. So we're going to go ahead and we're going to sell this. We're going to put this in our stock group. I'm going to actually put this in my covered calls and cash secured puts group. And then I'll move the stock over to this as well. So bringing in theoretically the midpoint about 58 cents. We'll sell that off. We got 58 cents for it. We'll move that there and kind of keep track of this. So I'm going to go back here to my monitor tab. Here's my Citigroup. I'm going to move that to my cash secured puts covered call group. Okay, so let's take, thanks guys for your patience and sticking around with this. Let's take another one here. And one of the things that we could do is, again, you can filter in your watch list or in the columns here, you can filter for that implied volatility level, that current level of implied volatility, right? So percentile, let's say, I think, do we have PERC? There we go, IV percentile. Slightly different calculation than current implied volatility percentile in terms of the watch list. But we can throw this into the mix here and use this as a category. As we click on OK, there's our implied volatility percentile. So I'm going to sort by this list. So kind of what, again, the confluence of this is, I want a stock that's given me some gains, so I know that it's moving in an uptrend. I want a stock that is relatively high in terms of that implied volatility percentile and has an earnings announcement somewhere over the horizon, kind of giving me that perspective, right, of what I might be faced with. So I'm going to take a name here that's got an implied volatility percentile above 50, above the 50th percent. So I'm going to look at something like, let's look at something like this one, Philip Morris. It's got an earnings announcement over the horizon. It's got an implied volatility percentile that's relatively high, likely because of the earnings announcement, and it's giving me some profit. So I'm going to go to PM. I've got 200 shares of this, so I'm going to go to the chart. I'm just going to put on the chart PM Philip Morris. And again, remember, this is not a recommendation by any means. This is just simply an illustrative example. So it's a stock that's generally been going higher. 50-period moving average is higher. It's running up into a resistance level. RSI is moving, so we've got some momentum, but implied volatility relatively high. So I want to see where that earnings announcement is over the horizon. A couple of different ways I can do that. I can add some time to my chart. So I'm going to add 50 bars out to the front. And I've got an earnings announcement over here on 7/22. Okay, 7/22. So what I'm going to do, excuse me, is I'm going to come back to the trade tab. And we're going to go down to our current implied volatility percentile, 74th percentile. We saw that on the watch list. We saw that in the list of stocks. We own the stock already. So once again, our goal here is not to have the stock called away from us. We just want to gain some premium. So we know that we've got that earnings announcement on the 22nd. So we know that this expiration, the 24th of July, is going to be the expiration cycle, and it's going to have some elevated implied volatility. Here's the thing. If I'm going to choose one that has a higher implied volatility percentile, I might be willing, because I'm selling further out and I'm going to sell outside of the expected range of movement, I might be willing to sell a little bit further out in time, simply because then I can capture maybe a little bit more of that time decay and implied volatility crush post the earnings announcement. So I'm actually going to go to this one right here. I'm going to go to the 31 July, which is just a little bit beyond the earnings announcement. Now, this assumes that there is still the possibility of some kind of extraordinary move on the earnings, some kind of news that drives the price of the stock, and so it could be called away. So you still have to answer the question, am I really, truly, honestly willing to sell the stock? And if you can answer that positively, then you got to go, we've got that kind of base question out of the way. So I'm going to go to this 31 July. Expected move is 15 points. So we're at 183. So I'm just going to grab this, we'll throw our calculator on here. 183, I'm just going to round this, plus, we'll call it 16, just to round up a little bit, plus 16 bucks. Means that 199 is going to be our expected range. Now, because remember, that could go down too. So we're going to think that the price of the stock might go from 183 to 199. Great for us if we own the stock, which we do in this case. So we're going to sell at 199 or above. So we're going to go to the strike price or to the expiration here, which is the 31 July, and we're going to look out at about 200 or beyond. And so that's going to put us in kind of right around that 15 to 20 delta range. Now, if I'm holding on, here's the thing to think about, right? If I'm thinking that the price of the stock might move on the earnings announcement, if I'm going to hold through the earnings announcement, then I might be looking at selling outside of that range. I would love if there were some more granularity to this, but there is not. I don't have a lot of granularity between 200 and 205. But I'm going to look at selling the 205 strike a little bit lower delta, a little bit higher probability of being out of the money at expiration, which is what I want to have happen. I'm willing to sacrifice a little bit of extra premium here for the sake of a little bit more headroom for the price of the stock to move in the context of that earnings announcement coming up. So I'm going to sell the 205 strike in this particular case. And I've given myself a little bit of room. Yeah, 74 is pretty unstable. It is at least an indication that maybe there's some demand prior to the earnings announcement of maybe some hedging activity, maybe some call speculation here as well, because that can drive implied volatility. So I'm going to try to work this a little bit. I'm going to see if I can get a little bit better. I'm going to work that up towards the mid price of 135. Remember that the paper money platform is almost always going to fill at the mid. But if you're trading in the live trading account, you may try to work that order up a little bit towards that midpoint rather than sending it off at the natural. So I'm going to go ahead and I'm going to click on confirm and send. We're going to put this in our cash secured puts group, bring in 135 bucks. And remember, this is 25 days, right? And we can then turn around and do it back, or we buy it back and do it again, right? So, all right. Yeah, and so again, and Mark, and I agree, Mike has his way of doing that. Super trend indicator, there's other indicators, whatever, that trend might move. So we're selling with a little bit of, essentially, here's what it comes down to. Let me go ahead and send this, and we'll kind of talk through this again. So we sold it for $1.52. We got it at the midpoint, right? So the idea of, let me go back to the chart. I think this maybe illustration would make more sense on the chart. So I'm going to squish this down. We sold up here at the 205 mark. So the idea here, selling at the 205 mark, is that if there is, I'll just kind of draw that. I'm not very good at drawing straight lines. But if there's more implied volatility, if that implied volatility is high, that means the price of the stock could fluctuate more, right? You could get more fluctuation. When implied volatility is low, that fluctuation is theoretically less. So with an earnings announcement, that brings higher implied volatility by nature because it introduces new information into the system. So that injection of volatility means that there's a greater likelihood of the price of the stock moving up or down. So when implied volatility is high, or when the current implied volatility rank is high, percentile rank is high, then we may give the stock a wider berth. Now, giving it a wider berth means that there's that possibility that we're not getting as much premium. But remember, implied volatility has been juiced up, so these premiums are a little bit more expensive. But it also gives us more opportunity for the stock to move up from where it is to where that level is that we sold. So if we were forced to sell, we were called away and the price of the stock had moved up, and we were just forced to sell at the 205, that gives us more price appreciation in the underlying stock potential than just bringing in the premium in the underlying, or the premium in the option. So we're kind of getting to that optimal scenario here. Now, Randy asked a question, how did I get to the expected move on Thinkorswim? It's on the option chain, and it's nice and easy to see. Come over to the option chain, and here's implied volatility on each one of those expirations, and here's the expected move that is displayed just to the right of each one of those implied volatilities. So there we go. Now, do I know what my cost basis is in Philip Morris? Trade price was 93, 73 and 93.30. So I'm going to say average was probably 93.45, which means that 93.40, or excuse me, 98.45. Oh, so we were at about 90. I'm going to just call it for easy math, $95. And it's now currently trading at $83. So that's my basis in the trade, or my cost in the trade on average, because I bought two different lots of stock at that price. So it's been going up. I'm okay with that in this particular case. I'm selling well above where the price of the stock is. I'm going to move one group of this. I'm going to move this higher group to my cash secured puts and covered calls group, so that I've got that trade here that we can manage on an ongoing basis. So we sold the covered call against it, and our expectation is that that's going to come back down. It's already coming back down, right? Yeah. You could, Sam, absolutely. Yeah. So if you've got a lower cost, assuming that I was willing to sell the stock, which I have to be, but my goal here is to keep the stock and keep that dividend flowing and keep that implied volatility going. So a couple of different ways that we can approach that. So the tools that we've used, and kind of wrapping this up in these examples, the tools that I've used in this process were my P&L open tool in the monitor tab in the position statement, right? Number one. Number two, I've added that implied volatility percentile column. Number three, I went to the trade tab and I looked at the current implied volatility percentile statistics here in today's option statistics. And then I looked at expected move, and I determined where the earnings announcement was. So covered calls ahead of earnings. How do you select a strike price for a stock that you want to keep? Well, this is maybe one way to go about doing that in creating a trade. So using all of these as a function. Really what it boils down to is, if you have lower implied volatility, you might think about so lower IV gets you a higher, I'll just use higher delta, okay? Higher IV equals a lower delta. Maybe just the way to kind of summarize this as well. All right, there you go. All right, so a couple of quick things before we go here, a couple of quick resources. I'm going to pop over here to the pop over here to the Trader Talks webcast page. You can type in the words covered call, and you've got a bunch of different webcasts that talk about covered calls. Cameron teaches a lot of that. Barb's taught a lot of that. Michael Fairborn. I've taught about it here as well in this process. There's Barb, there's me. Now, here's the other thing. Oh, Brent Moore's as well. Here's the other thing that I wanted to point out. Coming up, if you are in the Chicago area, and I was just there last week, just there yesterday, as a matter of fact. But coming up, 17th and 18th in Schaumburg. And I get it, Schaumburg's not Chicago. Schaumburg is a western suburb, but you can sort of see the skyline from there. But we're going to be doing on the 17th and 18th a technical analysis and option strategies workshop. Barb's going to be there. Barb's going to be helping to teach the covered calls section on day 2, which is Saturday, in that option strategies workshop. So if you're in the area, or you want to travel, you want to come and visit us, this is at no cost to you. We'd love to have you join us for this technical analysis and option strategies workshop. The next one that we've got coming up is in Orlando, the next workshop we've got coming up. But we've got a market drive coming up in Dallas on August 1st. So we're going to be in a lot of places. We'd love to have you be there with us and join us for those particular events. Give us a quick follow out here on the Trader Talks webcast page. You can follow me on X at Ben Watson CS, as well as on LinkedIn. Same thing with Barb Armstrong at Barb Armstrong CS. Guys, thanks for stepping in with me today and learning a little bit more about covered calls. My thanks to Barb Armstrong, our great reviewers, and our great production staff. Have a good day, everybody. We will see you again very soon. Coming up next, Liz Ann Live with Joe Mazzola and Liz Ann Saunders. Take care. Bye-bye.